Aloha and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. We are locking in for episode number 9, growth decisions at lower valuation. You can grow faster and still become less valuable because some growth decisions increase risk faster than profit. We're going to play a game for a minute. You're an investor. You're going to buy a company. You're going to purchase an organization. You're going to purchase a practice. And you're looking and you're digging into the books and you're zeroing in like, okay, where is the risk? Is the growth of this company real or is it fabricated? So valuation just doesn't come from growth. It's the quality of the growth. Durable revenue, clean margins, low volatility, and transferability. And what the real word is that we're looking for is consistency. So let's say as an investor, you're looking at a business, an opportunity, a practice, and you start going, wait, time out. There's some risk here. This doesn't feel real. It feels fabricated. And it may not be done on purpose because some people don't know. I have a friend, John Benson. He's a copywriter. He has this phrase, it's not your fault you didn't know, but now that you know, it's your responsibility. And I'm going to plug that in right here to this episode that you can't unring the bell. And when you start hearing about how organizations make purchases, whether it's a private equity firm, whether it's an investor, whether it's an investment group, the word comes down to quality. Like that's the major play that they're looking for because they want to be able to repeat what they're buying. I want you to think about something when it comes to the purchase, and that is that buyers price downside first. They're asking questions. What can go wrong? How is it going to go wrong? And then how much is it going to cost to fix it? And then they start going, okay, well, what's the quality expression of the cash flow? How do we know that that cash is going to be there? How do we know that the profits are going to be there? And you could have started with a really high multiple and then got ding after ding after ding, and then ended up with a mid-level or low-level multiple for your business. And what is found is that founders will optimize for speed. They're like, let's just get to a number. Let's get to top line rev. Let's get to top line revenue. And buyers optimize for certainty. They're looking for that quality, repeatability, control, clean economics. What they're really looking for is, hey, at the end of the day, you are going to turn this business over. And we want it to be turnkey. We want to know that if on January 1st you walked in, turned in your keys and said, I'm done, can this be replicated on January 2nd and for the rest of the year? And really good ran organizations or really good run organizations, that answer is yes. Hands down, that answer is yes. What will happen is you'll get to certain decisions inside of the company. Hey, we know we're selling, so let's just go after all revenue, aka bad revenue, to hit targets. So it could be underpriced deals. You know that the metrics show that that deal should be minimum of 20 grand and you sell it for 15. Or heavy customization. And there are certain industries where customization is common, but the more customization that something happens, you're talking fulfillment now. You're talking expectations being set. You're talking if that person cancels or there's chargeback there, that's an element of churn. Or we'll fix it later, right? We just got to get this deal over the finish line. Well, there's probably holdbacks on the deal. And if you have this belief of we're just going to get it over the finish line and we're going to get it done, there is going to be a ding. There is going to be a chargeback. And what will happen is bad clients create margin drag, delivery chaos. And this really comes down to the profits cover sin model. If you've never heard that term before, one of the things that you'll hear sometimes people say is profits cover sin or revenue cover sin. Meaning if we could just prove the numbers are there, then we're just going to keep going because there's no harm and there's no foul. When it comes to selling your business, the harm and the foul is going to be the dings and the dents. Decision number 2 on this is over-reliance on one client segment, one channel partner to deliver deals. And what you're going to find is that like you could think that one partner makes everything look efficient until it becomes a single point of failure. It is a risk. So you're going to find a lot of companies will say, hey, we don't want to see more than 20 or 30% of your revenue coming from one area, one segment, one client, one marketing channel, because there is a lot of risk to it. I've looked at deals where 100% of the business was one client. And that's just too much risk. You know, somebody says, oh, well, the company's sold. New relationship, we're going to go shop this deal. You can get some agreements, you can get some contracts in place, but think in terms of if you were to switch roles and you were going to buy the organization, what would you want to see? You would absolutely want to see some diversity. You would absolutely want to see that one client is not the only client. You would not, the risk ratio just goes through the roof. Decision number 3 that is a mistake is just adding more headcount. You know, I've heard this before, and I can't tell you who it came from, but it didn't come from me. And it's no description, no position. No description, no position. I would love to give attribution. If you know who it is, thank goodness. But I will let you know it's not my saying, it's not my phrase. It came from somebody else. And so adding employees without processes, without rules, without determinations is not going to net you what you think it is. It's going to be inconsistent delivery. It's going to raise the overhead, and it's leadership with bandwidth collapse. It's going to fall apart. Remember, you know, because it's held by duct tape, bubble gum, and chewing wire and baling wire doesn't mean it's going to be good. Decision number 4, custom works that breaks repeatability. I will share with you, when I first started as a consultant, I had a mentor that pulled me under his wing, and he said, Scott, the more that you try to do custom work and the more that you keep trying to figure out custom things for somebody, the tougher your role and responsibility is going to be, because from any given day, you have a million different things that you're trying to achieve for the people that you serve. He said, pick a channel and stick to it, right? Pick an idea and go with it. And custom equals harder training. It requires specific people. It requires difficult forecasting, margins that you got to use space math on. And the buyers, when they see this, it can look like chaos to them. What is going on here? How come you have all of these different programs? So one of the things that you'll find, especially in restaurants, is consultants will go into restaurants and they'll narrow the menu. And then what they'll do is they'll cross foods. Like, okay, what on the recipe takes a bunch of eggs? And then they'll make a list. And they'll say, what on the recipe doesn't take eggs? And then they start saying, okay, we're going to try to start using the same kind of ingredients in most of the meals for breakfast. And then for lunch, we're going to use a lot of the same ingredients to make lunch, and we're going to do the same thing for dinner. And they start paring down the menu. And part of this happens inside a business to look for the most profitable part of the business. And this does take some research, because you can shut down a profitable business line just based upon looking at it at a quick glance. But you may find that one line of business is way more profitable than the other. And this allows for you to start taking a look and saying, okay, at the end of the day, what can we take out of our menu? What doesn't belong? And a lot of times you're going to find it's custom work, because it's the amount of time, it's the amount of drag, it's the amount of deadline that's put on the team, it's the amount of fatigue. Number 5, discounting is a growth strategy. You know, discounts, when you take a look at them that aren't tied to some sort of written policy or plan or guardrails to protect profits, is weak. Discounting to get to a revenue number is not going to be quality. You're going to end up with a diverse group of people. And I will share this with you. I managed a really large sales team at one point, and the worst people to deal with were the people that shopped on price. They didn't see the value. They were never going to see the value, and they were just a pain to deal with. The management team spent more time dealing with upset clients that didn't pay full price than the other way around. And some studies were done, and there was a watermark that was put in that said, you cannot discount past this point. And something like 50% of the complaints that went to the management went down by not accepting low bids to price match, or to get work, or to make stuff happen, because it was a matter of constantly going back and having these people on the phone. What we did was we assigned a value to 15 minutes of the phone for a manager, or for 30 minutes of a phone, or for a site visit. So we broke down and said 15 minutes, 30 minutes, 45 minutes, an hour. What's it cost to send somebody out to fix the problem? We're not even including the team. We're just saying straight management. And we found that the number became too great and it didn't make sense anymore. Decision number 6, tech sprawl and tool stacking. Too many systems equals too many chaos. It creates data conflicts. It creates problems for trying to forecast. There's reporting gaps, and it just makes due diligence a mess. You don't want chaos and confusion because you're going to get a chaos and confusion ding. Quick break and message from your sponsor, Scott Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. Number 7, growth that increases owner dependency. When you have the top dog, the person at the very high end has to do a bunch of work to get deals over the line, and then you get founder approvals and founder relationships. What you're going to find is that's inconsistent ability. That founder can't go on vacation for a long period of time without being disturbed. That's a misuse of management. And what you're going to find is this, like, that's a ding. Like the entire episode, every time that one of these things gets mentioned, you should be thinking, that's a ding. Number 8, ignoring retention to chase new logos. And this happens a lot in SaaS, but this can also happen in different industries and services. Let's go get new clients because it shows revenue. It shows growth. When you look at the math of acquisitions for the cost of a new client, what you're going to find is it's typically greater than keeping the one that you have and selling them more. And so if you have something that looks like it's a lot of churn, it's a problem. It's a ding. Buyers see mistakes in due diligence. This is what they're trained to do. They sniff it out. There is some MBA that's 23, 24, 25 years old that's good with an Excel file, that's magnificent with an Excel file, and their only job in life is to be like, there's a problem here. So they look for margin inconsistency. They look for complaints. They look for messy reporting. They look for weak SOPs. They look for pipeline unreliability. And all these end up as surprise add backs. They start taking away dings and dents out of your money that you could have fixed. And here's the way that investors look at it. It's a good deal for them. They already know what they're going to do. They've already got a playbook. If you have things that are out of place, what they do is they go, we're going to give you a discount, and it's just going to take 2 or 3 months longer or 4 months longer for us to get our money, and we're okay with that. We're in it for the long run. You might as well get your money. It belongs to you. You should be going after it. You need to have an action framework. Before saying yes to growth, ask these 5 questions. Is it repeatable? Is it predictable? Does it give us margin quality? Does it help with client diversity? And does it strengthen leadership? These 5 questions, and I'll repeat them again, these 5 questions are beyond important. Is it repeatable? Is it predictable? Does it give us margin quality? Does it give us client diversity? And does it strengthen leadership? This week, your role, your responsibility is to audit one recent growth decision and ask, did this increase enterprise value? Or did it buy revenue at the cost of increasing risk? And just do a quality check. Just for a moment, detach from your company and ask a bunch of questions. How did we get here? And is this true? And what assumptions are we making? And you're going to find that sometimes by taking 15 minutes, by taking 30 minutes, by taking an hour, you'll uncover problems inside of your business that you didn't know you have that could be solved in an afternoon. It stops you from getting dinged and dented and losing a bunch of your valuation. That's your money. You built the company. You should get as much as you can for it. Mahalo for listening to the Scott Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, Visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.